Back with First Trades, right here, Neeti, now addressing a whole host of earnings. So let me welcome on board Prashant Tripathy, the MD and CEO at Max Life Insurance, joining in on the show right now. Prashant, hi, morning. Good to have you on the show. You've managed to grow your APE faster than your peers. Is this performance expected to continue? And which products drove the growth for you?
Thank you. That's a very good question. Actually, if you look at the quarter, the private industry average growth on collected premium basis, new sales is about 16%. And as against that, we've grown about 32%, which is almost double the rate. And this is an outcome of a very well thought through strategy that we deployed actually to drive growth in both our online, offline proprietary channels, as well as with our partners, as well as focus on acquiring new partners and relationships. So if I look at where we are in the business and I look at the momentum, I expect that the momentum should continue and we should continue to outperform our market peers.
The share of ULIP and par saving has risen at a cost of non-par, which has been consistently falling in last 2 quarters. So what is the strategy of product mix going forward?
So your observation is correct, and that is an outcome of some of the tactical moves that we made as per our product calendar in the first half of the year. We had 2 specific products that we launched in the first half of the year. One was on par platform, and the other one was an index-linked small cap fund that we launched. Because of these 2, the share of ULIP as well as the share of par has gone up. To talk about ULIP, we have seen a distinct bias towards ULIP because the markets were kind of moving up. As we go in the second half of the year, we have, as per our calendars, we have other product launches more in the zone of non-par, and I anticipate that the product mix will get rebalanced. So you should anticipate to see some movement to take place from ULIPs and par to more non-par, and that will rebalance our product mix, as well as have a positive impact on our margins too.
All right, and your VNB margins, they were compressed at about 25.2%, the highest year-on-year decline among your peers. So can you help us understand what transpired?
So basically, let's take a step back. We finished our year last year at 31, little over 31% margin. And ever since this year began, I have been guiding, saying this kind of margin for Max Life Insurance will be unsustainable. And the guidance that we've given to the market for the full year is between 27 to 28%. Where we are right now is as per plan. It was supposed to be compressed. So really the reference of last year is not appropriate for us. As we move forward, like I mentioned to you, margins get driven predominantly by product mix. And product mix is dependent on market demand, but also on product launches. And in the second half of the year, we have a slew of products which are being launched, which I hope will have a positive impact on margin. So while your observation is correct that compared to first half last year, we are about 270 basis point lower on margin. You just took the reference of comparison of Q2 to Q2. This is aligned to how we are trying to work through and navigate the business. There's a lot of focus on building distribution. There is a lot of focus on market share, and some bit of compression on our margin was expected. I'm hoping that with all the initiatives that we are going to take in the second half of the year, it will get corrected and go back to what our guidance was.
Right. Prashant, so what is the guidance for margins for FY24 and beyond?
Actually, by the time we finish the year, I expect our margins to fall in the range of 27-28%. And, I think it will remain at that level and improve marginally, maybe 50 to 100 basis point going forward. That's the anticipation.
What is the update on the regulatory approvals for the capital infusion by Axis Bank? When is the RDA approval expected to go through?
So we have filed for approval, and everything is in order. There are 3 regulatory approvals we require. Actually, one with IRDAI. We also require approval because we have a pension fund management business. We require approval from PFRDA, and there might be an approval required from CCI. We are in the process. We have filed for approval from IRDAI and PFRDA. The approval for CCI is going to be filed soon. And I'm hoping that by Q4 of this year, which is last quarter, we should have all the approvals in place.
Bank insurance channel as well has seen strong growth. How much of this has been driven by the Axis Bank channel? Tata AIA has not started selling at the Axis branches. When this does happen, do you see any challenges?
Basically at Axis Bank level for quarter 2, we saw a growth of 28% from Axis Bank, which is very solid growth. And, that has given further momentum to Max Life Insurance growth. And this growth is superior to all other bank assurance counter growths. As you know, for last many quarters, our counter share at Axis Bank has been stable at around 69-70%. And with the bank believes in open architecture, and in case it were to open further to more players, we expect our counter share to remain in the range of 65-70%.
Right. Earlier, you had mentioned that you're also trying to build distribution, your proprietary mix-led growth this time around. But going forward, how is it that you think your sourcing mix is going to look like?
Just to clarify, I think quarter 2 growth was quite organic across all the channels. So while on proprietary channels, on written premium basis, we grew 32%. Our bank channels also grew 32%. As a result of that, quarter 2 growth on collected premium basis was overall 32%. So I'm just confirming that all our channels are doing very, very well. If you were to look at the first half of the year on APE basis, our prop channels grew 42% against 15% growth from bank channels. So, of course, in the first half, the proprietary channels have grown faster. And as a result of that, their share in total business contribution is close to 40%, which is higher than how it was a couple of years ago. We anticipate and we also plan to invest more and more in our proprietary channels for them to become a driving force and an engine for growth for Max Life Insurance. We're making investment in our agency, our direct sales force, our digital channels, and we are recording significantly high growth in all those 3 channels.
Thank you so much for taking time out and joining in and running us through your business outlook.